the quarter. The quarter's focus continued to remain on collections across all the products. This was principally because all the restructured loans resumed their monthly billing during the second and third quarter. We had already informed you earlier that the maximum holiday break that we gave in any of our restructured loans were only 2 or 3 months, which meant that all the restructured loans started their billing either on the second quarter or in the third quarter. And we were very keen to ensure that as the billing starts, the collection efficiency remains very strong on top of this restructured book, so that we are sure that we are having everything under our control. We are also happy to share that the largest book, which is our small business loan, continues to show very strong signs of stability and comfort. Microfinance and vehicle finance have taken a little longer to normalize. However, we are seeing collections picking up quite well from the delinquent accounts. The gross NPA slippage has been the lowest in many quarters, and the recovery continues to remain strong. The GNPA has come down to 4.39 from 4.64% of second quarter. The 1 to 90 DPD, which touched a peak of 26% in June 21, has come down to 13.5% in December. Combined with high expected collection efficiency, we believe the COVID stress on our portfolio is behind us now. Further, out of this 13.5% 1 to 90 DPD, 80% are from secured loans, giving us further comfort on ultimate recovery. The restructured portfolio was our focus, as I mentioned, for the third quarter, and I am happy to say that the portfolio is stabilizing quite well. Rohit will give further details on the same. On the liabilities, the strong performance of earlier quarters continues. We continue to open record number of new savings accounts led by our digital acquisition channel. Our video-based full KYC conversion has been rolled out, and it is helping us convert these digital accounts to full KYC, helping us create value out of these acquisitions. Our CASA has inched over the 50% level, and we will work very hard to keep it at these levels, even as our overall deposit is set for further growth. Murli will give further color on this. The NIMs at just over 9% are back to our pre-COVID levels, mainly because of lower NPA slippage and resultant reversal income. If you notice, our gross yield has been pretty steady around the 18% level. Our new business lines of used car finance and affordable housing finance are doing well and scaling up quite well. Rohit will give further details on the same. With the portfolio performance settling down well, GNP under control, lower bucket DPD is coming down, the bank is well positioned to get back to its growth story. We believe that we should be back to our pre-COVID levels of growth from the next year. On that positive note, I would like to hand over the mic to Rohit.
Thank you, Vasu sir, and good morning, everybody. Rohit here. The year-to-date, year-on-year growth in advances has been at 14%, and growth on sequential quarters is at 4%. Growth could have been better, but for the conscious decision to focus on collections in October and the squalls and rains that hit Tamil Nadu in November, December has seen good disbursements. We see strong demand coming back in the small business loan segment, which contributes 45% of our book. In vehicle finance, medium and heavy commercial vehicle sales have seen a strong growth after a long time. Last quarter saw sales of 64,000 units against 50,000 units over the same period last year. Freight rates have gone up substantially, increasing the free cash flow of fleet operators. Truck utilization rates have gone up significantly, which is contributing to increased income for them. These factors are driving the replacement demand. ICRA has estimated a growth of 40 to 45% for medium and heavy commercial vehicles for this year. This augurs well for us as a growth in the formal sector eventually propels growth in the informal and used segments. LCV sales continue to grow as the load availability for last mile transportation continues to be strong. Growth in this segment is estimated to be at 9 to 10% for the year. Two-wheeler sales, however, two-wheeler sales have seen a degrowth of 20% last quarter. This does mean that the growth in the formal sector has yet to fully percolate through the informal sector. In MFI, we have seen increasing overall collection efficiencies across geographies, However, the X-bucket collection efficiency and MFI is still at 97% against the earlier normal of 99%. The increasing overall collection efficiencies across geographies give us the confidence that the coming days will be better. The affordable home finance advances have seen a very strong growth, though against a low base, with hardly any delinquencies at all. Sequential quarter growth is at 30%, and year-on-year growth is more than 200%. On the restructured pool, 67% of our restructured portfolio in small business loans is non-delinquent. In MFI, 45% of our RSL pool, restructured pool, is non-delinquent. In vehicle finance, 45% of the book is still below 90. And we are seeing increasingly better collection efficiencies in the last quarter. Overall, the mood seems to be buoyant, and we are hopeful of both good growth in advances and healthy improving collection efficiencies. Thank you. Over to Murali.
Good morning, and thank you for joining. Let me also take this opportunity.
Members of the management, we cannot hear you, sir, at the moment.
Can you now?
Yes, now we can hear you.
Yeah. I was just saying Happy New Year and Healthy New Year to all, and I was trying to give an insight. Before getting into the numbers, actually, what we have laid as a roadmap for us in terms of product, in terms of approach, in terms of pricing, and in terms of marketing and leveraging on digital, which we have been sequentially talking for the last 2-3 quarters, I think that trajectory of work, trajectory of approach, nothing we did change, and we stuck to that. And I think we are seeing only a continued pace of momentum gaining over this period. So if you see the savings account as a growth, it's predominantly driven by top line, that is acquiring the number of customers, and that coupled by enhanced relationship management, where we put physical, that is branches and people, over the digital mode of acquisition to deepen the value as an approach, and targeting mass affluent and HNI. That is one part of the story which is brewing and growing well. Parallelly, what we were focused on is how do we enter the house through product holding. That has helped us to get 3 things right. One is product holding, if you see, where we have enhanced our portfolio close to 24-25%, and active and primary account has moved up beyond 60%. These are 2 encouraging signs where people not only prefer us to park to only save, it's also they are using our relationship to deepen, to enhance the relationship value, which speaks very high about our relationship skills. And we backed it by a spend segment for the first time for the last 6 months. Our debit card activation and the absolute realization in terms of unique customers added has actually helped us to get stability in terms of primary and active accounts. This on one side. Digital, we had 2 segments, B2C, that is selfie, and B2B2C, where we have a fintech partnership which is running. B2C, we consciously toned down to play down our expanded portfolio model to a restrictive and focused model. So here we can proudly say that on the targeted segment, we have calibrated ourselves to target the correct demography and wanted geography. In UX, that's a fintech model where we are going to do the same thing in coming days, where so you actually multiply your quality through at the sourcing stage itself. Now, in terms of mass affluent, Elite has been a very successful story for us. I think now Elite customers are seeing value in terms of not only the product and proposition, also in relationship management and engagement skills. To enhance the proposition, we also did ASBA as a last quarter product initiative. I think already we had a 3-in-1 on the previous quarter, 3-in-1 with ASBA put together, actually helped the customers to migrate towards investor and traders coming in. So that's a welcome move in terms of expansion of segment. Now, next comes the most important phase of investments and protection. If you see, we have a pool of insurance and pool of investments as an approach. So that has actually helped us to expand the number of bases whom we cover through protection as well as through investment. So we are now being judged by BSE as one of the top distributors for mutual funds also. So the expansion now is not only restricted to savers and spenders, it is also expanding into traders. And last but not the least, while the inward remittances have come down at an all India level due to uncertainty, for us the NR segment has been a big gainer, and we are opening up new markets, and inside few of the markets we are taking a strong foot forward. That's one good segment, along with EVA as a women's segment, which has been a value growth. So overall, it's a good sustained momentum we could see. And most importantly on marketing, which is actually playing a very active role where we are positioning as beyond banking as a theme, and a few of our library collection of success stories which we keep putting into the stream has started attracting a lot of attention and a lot of purpose being attached towards the depositor, because they could understand we also deploy it to the deserving section. With that note, I will hand it over back to Mr. Sridhar, who is our CFO.
Thanks, Murali. Good morning, all. Now for a quick update on the financial performance during the quarter. Our net interest income came at 541 crores as compared to 484 crores during the same quarter last year, registering a growth of 12%. Other income came at 134 crores as compared to 155 crores in the same quarter last year. The variance was primarily driven by lower PSLC income and other treasury operations. Net income grew 6% and came at 675 crores for the quarter as compared to 638 crores during the same quarter last year. In the current year's presentation, we have your feedback and have also shown operating expenses after netting of digital expenses with digital revenues. This can be seen in slide number 16. We have also recasted the cost to income based on this for the previous quarter in the same slide. Hence, our cost to income based on this comes to 64.67%. The total operating expenditure net of digital expenses came at 411 crores as compared to 334 crores in the same quarter last year and 391 crores in the previous quarter. Our pre-provisioning operating profit PPOP came in healthy at 3.5% of the assets, which is about 225 crores compared to 199 crores in Q2. On a PPOP basis, we are quickly returning back to pre-pandemic levels as our NIM improved to 9.09%, led up by improvements in cost of funds and lower income reversals due to slippages. We have also provided the trend of a daily average cost of funds in slide number 14. For the current year, it stands at 6.47% compared to 7.27% in the same quarter last year. On a quarterly average basis, it is 6.97% as shown in slide number 6. Going forward, we will show only the daily average cost for the quarter to reduce confusion. Now moving on to asset quality provision and restructuring. Our outstanding restructured advances as on December 2021 is 1,764 crores, approximately 9% of our advances. We have provisions to the tune of we have provisions to the tune of 300 crores against this pool. During the quarter, our overall credit cost came in at 78 crores, down to 142 crores of Q3FY22. We have also made additional provisions of rupees 28 crores toward microfinance over and above the bank's provisioning policy. Including this, now we have about 315 crores of additional provision, including floating and RFL provision. The PCR contracted to 46% despite making additional provision as we wrote off 94 crores loans during the quarter, which was 100% provided for. We expect to see the PCR to move up as our current provisioning policy had been accelerated last year. To give you some more color of how the overall 6.61% is 30 to 90, NPA is 4.39%, which means approximately 7% is in 1 to 30 DPD. However, in our RSL book, 46% is standard and 9% has moved to NPA. Overall delinquency at the bank level has reduced from the peak of 20% plus to current levels of 14 to 15%. We expect this to further contract if we maintain the current levels of collection. Lastly, during the quarter, the bank's ROA sharply improved to 1.7% and ROE at 12.27%. We hope to see these numbers further improve as the business environment clears up and there are no further pandemic-led disruptions. Thank you.
Should we begin the call with the Q&A session, sir?
Yeah, Margaret. Let's start the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, you may press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Digant Haria from GreenEdge Wealth. Please go ahead.
Yeah, hi sir. So my question is on the small and medium business portfolio, which is our largest portfolio. So the way things are going in COVID, we would that this is a segment which should offer a lot of stress because this segment has been under stress, but our portfolio has held up quite well over maybe last 2 years. So if you can give just some color on how are we looking at growth and how did we manage so well over these last 2 years in this portfolio, because I know it's a LAP portfolio, almost 6,800 crores, but how did we manage it so well in these times? So that's my question number 1, sir.
Yeah, good morning, Jitin. So, I'll go to the Digant. Good morning, Digant. Sorry, Digant. So, I'll go to the evolution of the small business loans. So, we started way back with microfinance. And as we kept understanding the microfinance customer, we also understood that he has many needs. And this was one particular need where we could help him grow his business. He could become an entrepreneur. He could, employ people in his whatever small shop or a small business activity, and that helped us in growing the book. So the whole evolution started because we started understanding customers. So that has helped us in very good state because all our business, about 98% of our business is sourced directly. We go to the customer and source that business. So that has really helped us in, increasing the book. Now, as you said, what is the plans for scale up? So currently, if you look at it, most of our business comes out of Tamil Nadu, but we are more focused now in getting business volumes up in the other states of Maharashtra, Gujarat, APTG. So basically, most of our business comes in South, and we are looking at non-South geographies to scale this business up. Does this answer your question, Digant?
Sir, a little bit. I just wanted to say this, that, even your competitors like, say, a 5-Star Finance or an Aptus Finance, they've all been doing this business in Tamil Nadu, and that part of the portfolio has held well for almost everyone. But how easy would it be to replicate this whole thing outside Tamil Nadu? Because I believe this is still a people-intensive business where your loan officers need to be on the ground, check the customers twice, thrice, and so on. So just wanted to know that part, that, is it scalable outside Tamil Nadu also?
See, today a very significant portion comes out of Maharashtra also. So we have already scaled up in Maharashtra. Where we need to scale up is in further geographies. In West is Gujarat, Madhya Pradesh. This business is scalable across geographies, but we need to understand, over the years, we've understood the customer, we've developed a USP of appraising that customer, understanding his needs, assessing his cash flows, which is all informal and which is completely assessment based. So yes, to answer your question specifically, yes, this business is quite scalable outside Tamil Nadu also, provided we can assess the cash flows of the customer properly.
Right, sir. Okay, sir. Thank you for this. So my second question is mainly on the operating cost. We have probably reached a run rate of around 1,600 crores per year, like if we just take this quarter's entire operating cost. So just wanted to check that, at what stage, say in the next year or 2 years, do we reach a stage where, the income growth is significantly higher than the cost growth? Because last 3-4 years, we have been plugging a lot of gaps. Like, initially we started investing in branches, then liability scale up, now digital acquisitions. So we have done a great job there. But just like, is it fair to expect that in next 1 or 2 years, or is it still a little more away that, the OPEX growth comes much lower than the income growth?
This is Vasu here. I'll take this question. If you look at our pre-COVID position, that is 2018, 19, 20, our major investment was really in the 16, 17 when we became a bank. 2016, 17 and 17, 18. That is when our major investments took place both on IT and on opening almost all the 375 liability branches, adding on nearly about 3,500 staff on the liability side. So all the real cost really incurred between 2 years after becoming a bank. Now, if you look at the data points, let's say 1920, you would see that the income, generally the income growth per annum used to be around the 30% level, and the cost growth used to be around 15% to 16%. So we were able to show that, after the initial investment that we went in, we were able to show that the income can actually grow at nearly double the rate at which the cost could grow. And I think that's a model that we have created. If you analyze our cost, practically everything is a fixed cost. We don't really generate too much of business through DSAs, except very small volumes in the new commercial vehicle. But for that, where we source through the dealerships, otherwise practically all our businesses are sourced directly. So we don't have a DSA cost, which means that there is no variability in the cost. So it's all about our own staff cost, which is fixed. And on collections, we don't employ any agency at all. So all collections are done by our own staff. So again, it's a fixed cost structure. So in the last 2 years, due to the pandemic, the growth in the NII has actually come down because the volumes, the AUM growth is also reduced. And because of that, the increase in NII has actually not been much. But cost-wise, it continued to remain and grow a little bit because there's a salary and the rental increase which keeps happening yearly. So that's why in the last, this year, in fact, if you see our NII growth was only about 9 or 10% in the quarter on a year-on-year basis. But going forward, as Rohit was mentioning, that the portfolio is now quite stable, and hopefully I am assuming that the COVID is more or less something that's behind us. At least we have learned to live with it. We have learned to manage it now, I believe, and so we should look for getting back to our pre-COVID levels of growth. And when we do that, then we will again see that the NII growth vis-a-vis cost growth should be back to our earlier levels, as I mentioned. And from a further investment perspective, if you look at it, we do have 390 branches now on the liability side, and more than about 450 odd branches on the asset side. And now there has been increasingly large amount of effort being put in by the team to try and make liability available at asset branches and vice versa. And so we will continue to expand by ensuring that all the products are available at more and more of the branches, which itself is an expansion from a geography perspective. We will continue to add branches, but it may not be very significant. Growth in branches may not be necessarily a very significant driver of our volume growth, while we will continue to add branches here and there from a strategic perspective. But we will continue to add people, both on liabilities, where we have seen an extremely good traction on the relationship management team. We have seen a very strong growth in terms of the deepening of accounts which are mapped to the RMs in the bank. So that's one area. The VRM, the Virtual Relationship Management team, which has also done an extremely good job over the last 2 years of pandemic. That's again an area where we want to expand that team, VRM team. These are things which will help us deepen the value from accounts which are sourced digitally. And on the asset side, we will continue to keep adding largely the field staff, be it the sales principally and to some extent collection. So this kind of a little bit of growth will be there in cost, but our NII growth is what we should be really focusing on, and I think that should come back to the pre-COVID levels very shortly.
Right, so thank you so much for this detailed explanation. So just like summarizing your point is that maybe costs will continue to grow at 15% because we are investing, but the moment growth is back, the NII line will exceed the cost significantly. So
Exactly, that's the whole point.
Yes, got it, sir. Thank you so much. I'm done with my question.
Thank you.
The next question is from the line of Amit Nanavati from Nomura. Please go ahead.
Yeah, hi, sir. Question firstly on the asset quality part. Your X-bucket collection efficiency, if I compare it with September, has come off. So just wanted to understand the movement here. Is it because the billing for the restructured book has started happening and that gets consolidated here, or if there is any underlying stress that we are seeing incrementally?
So, good morning, Rohit here. So, collection efficiencies across have gone up. You are asking about X-bucket specifically.
Yeah.
X-bucket collection efficiencies. As I said, as I mentioned in my opening notes also, except microfinance, which is, at 97 against a normal of 99. Across, small business loans are at 98%. And then your vehicle finance has also moved from 93 to 95%. And this is despite the fact that our entire restructured portfolio has started its billing in December. Because we had given only a moratorium of 2 to 3 months. So some of it started in October, some of it started in November, and some of it started in December. But as of now, the full RSL book, the billing has started. And despite that, in both small business loans and vehicle loans, we are seeing increasing X-bucket efficiency.
And so if you can give some color on the restructured portfolio side across segments, what's the Npa levels across MFIs, small business loan, vehicle finance, that will be helpful.
Yeah, Amit, Dheeraj here. So Let me give you that breakup.
Members of the management, we lost your audio, sir.
Oh, sorry. So, Amit, just to give you the breakup, like Sridhar mentioned, the outstanding is about 1,764 crores. Right now at the bank level, that restructured portfolio, about 46% is standard, about 19% is 1 to 30. Generally, you don't look at 1 to 30 because this is a high check bounce business, so we tend to collect most of it. 31 to 60 is 15%, 61 to 90 is 10%, and NPA is 9%. So that's the mix of 1,764 crores. In specific, if you're asking about small business loans, I was taking you through all products that I'll be rattling out, I think, too many data points. But the largest product, small business loans, about 66% is in standard, about 14% is in 1 to 30. 31 to 60 is 11%, and 61 to 90 is 4%, and the NPA, which has slipped into that, is about 5%. This broadly is about double the other books. So from a comparison, SBL is performing quite well in the RSL pool.
Yeah, so fair to assume vehicle finance is where you would be seeing a higher NPA level in the restructured portfolio.
Yes. So you're right. About 11% is slipped into NPA, and from a restructured book, out of the 1,764, then close to 900 odd crores is in vehicle finance.
Got it. Secondly, on your ROE trajectory, right, into next year, if I look at your margins is back to pre-COVID, credit cost at 1.6% is nearly back to where the business profile will allow you to. OpEx obviously will grow as it's growing. It's largely an outcome of growth profile. So just wanted to understand what levers beyond growth you have in terms of improving your ROE profile, or it's just an outcome of growth that you'd hope the ROEs to improve?
So for us right now, it's only growth, the asset growth. Cost of funds has come down well, so that will cushion some of the NIMs. Yeah. So apart from the asset growth, the other line item is the fee income. So if you look at it about 5 quarters back, it was the liability fee income and the digital fee income was almost non-existent. And today it's growing quite fast. So that will grow, not in line with how the other books grow, but it should grow exponentially. And most banks, that contributes a significant revenue line item. And if you are talking of long term, I'm assuming that we will not be a small finance bank for long. So as we become a universal bank, there may be other factors which will come into play, which should help build up the fee income. So I think ROE will get supported primarily through loan growth. Second would be the fee income coming from our existing liability channels, and I think the third one would be if and when we convert into a universal bank.
Got it. That's it from my side. Thank you.
Yeah, thanks, Amit.
Thank you. The next question is from the line of Harsh Shah from Dimensional Securities. Please go ahead.
Hello.
Yeah, yes, so we can. Okay, can you speak a bit louder or come closer to the phone, Harsh? We cannot hear you very well.
Is this better now?
Yes, thank you.
Yeah. So coming back to the point on our operating expenses, if I look at YOY comparison, we have gone up from 150 crore to almost 210 crore. Now, if I look at the presentation of last 3 to 4 quarters, the banking outlets which we refer has remained stable at 861. So just wanted to understand that where actually are we spending this amount, because this is nearly 30% increase. So number one, on OpEx side, number two, even on digital spends, when we talk about spends on technology or digital, what exactly are we spending on, and if it is, and why are we not capitalizing it? So just wanted to understand that.
I'll take the digital part first. So we have, when we say digital, these are all business-related expenses. So if you are earning 10 rupees, 8 rupees is passed on to digital, to our partners. So either if it is on the prepaid side or on the ATM or the micro ATM side, and there is or the FASTag side, all of those partners tend to take about 80%. So that is, and then lastly, the marketing expense, I think that Murali had spoken about. When we talk about our selfie, we've ramped up how we acquire customers digitally. So that involves a lot of online advertising and online marketing. So these are some of the spends which come in from the digital space. The other digital expense, which is actually captured within our OpEx, is more from, I would say, digitization. So some of the large, I won't say investments, large projects we are running is on we are revamping our loan origination system. We are revamping our entire CRM from a sales and service perspective. We are putting a state-of-the-art platform. We are embarked on an enterprise data warehouse to help us on the analytics journey, especially in AI and ML. So those are some of the large projects we have taken up, which is also coming in the OpEx, either in the form of a capital expenditure or in terms of a revenue expenditure. So these are some of it. But it is not on branch additions, you're right. The branch count has not materially moved. We have opened a few branches. I think Murali had spoken about it in last quarter in Kerala. But those really won't move the needle. On the OpEx, the other color is, I think what Vasu had touched, the last almost 18 months, the manpower we have invested in, apart from the housing, which I think we mentioned that last quarter, about 200 odd people, which are on frontline, which is actually being put on productive use, which is why the housing portfolio is growing. The remaining team is broadly not doing origination because we've deployed them from a collection perspective. So some of those strengthening is what we did, given that the pandemic focus on collections and additional manpower was put there. and as and when we switch on the growth mode, which is likely to happen from this quarter, they will get redeployed to frontline staff, and then they start helping in origination. So there is also some bit of that operating leverage which will come in. So that's the color of the operating expenses we are sitting on.
So one line item, we have employee expenses, which has gone up from 205 crore to 240 crore YOY. So that you explained that the employee count has increased. So below that, if I look at other expenses, it has gone up from 110 to 152 crore. That's like 40% YOY increase. So my question is, where is that 40% increase coming from? If our branch count is almost same YOY, then what is leading to that 40% jump in expense? And this is X technology, as mentioned in your slide 16.
This is Sridharan here.
Yeah.
See, in addition to the employee expenses, which have gone up from 204 to 240 compared to last quarter, there are other expenses which MD mentioned. That is, the rent expenses have gone up because of the incremental increase and other things. And also the technology expenses, it is almost because the AMCs are coming and it's all 5-year-old and other things, which you invested 5 years ago and other things. So on that account, the revenue expenses are all up. Almost, the IT expenses, is 70-75% more than the spent in the last year, the same quarter actually. Also, the rest of the other expenses, if you look at, they are moving along with the business actually. And as we mentioned, most of the expenses are almost fixed actually.
Yeah, I understand it's fixed, but 40%, because I'm referring to expenses without technology. As you have mentioned in slide 16, you have mentioned this is excluding of digital expenses. A jump of 40% is something which is very high. I mean, rent expense would increase by 5, 6, 7%. But 40% jump is something which I'm not able to interpret. I mean, where is that increase coming from? Because employee expense has been explained in separate line item. That I buy your point that you have increased the count. Digital expenses you have excluded from this other expenses. But this 110 going to 152, 40%, because our loan book has grown by 11-12%, but other expenses has grown up by 40%.
In fact, now I have briefed you that the other expenses, there is a rent, other things, electricity and other things gone up closely, actually 25%. And IT expenses, the major expenses, which has gone up actually, I told you around 65 to 70% actually. These are two major expenses. And also, if you look at the last year same time, because certain lockdown and other things, and the business growth was less at that time actually. So the DSA expense a little bit gone up, maybe 20, as per that, this one is 26%.
Okay. I think I'll take this offline. There's still some clarity that I would like to have. So, and also for this quarter, can you explain what is the prepaid card fee income and what would be the expense for the same?
See, like Dheeraj was saying, branch banking is a fixed expense model. This entire digital banking is a variable cost model. So which means it is based on the number of transactions, and that is dependent on the circulation of AEPS, ABPS and the demand for prepaid card. So we are now, as of now, issuing close to 2 lakhs of prepaid card month on month, and out of that 60% is active and 70% does a transaction. So this is on a 13 bits model. So it is directly proportional to the cards we issue, cards we active. So it is absolutely variable by nature. So this quarter, if the market opens up, we should see at least this going up by another 10 to 12%, but the realization will remain the same, 13 bits. It can't change because of switch cost, interchange cost, and MDR being fixed at the beginning of the contract.
So what is the amount for this quarter, prepaid card fee income?
It's about 20. And about 80-90% is the expense towards it.
No, actually, can you repeat that? Your voice broke in between.
20 and 2.
20 crores is the gross revenue.
And 80% would be expense.
Yeah, correct.
80 to 80 will be slightly higher. Yeah,
15 bits is our realization. 20, 17 and 3 is the thumb rule.
Okay, 2017 and okay. And so I think this number dipped quite a bit, right? Because we were going at a run rate of around 50 to 60 crore, or 40, and now this has dipped down to 20 crore.
Yeah, you're right. So this was, your numbers are right. It was close to about 40 crores the previous 2 quarters. The number has dipped. It may be also with some restrictions, but I think this will come up.
We have started calibrating on half KYC cards. We are focusing more on full KYC cards. So in the half KYC cards, there is an element of risk categorization we have done, and we have exited few markets and segments consciously.
Okay, and also, is it also a function of our take rate coming down? Because a lot of competition is building up in this space.
Yeah, that is also there. See, but that is a relative effort. But the absolute reality is we exited few segments and few markets consciously on half KYC prepaid cards.
And what is the run rate that we should work with for next, say, once everything opens up?
See, it is directly proportional to migrant labor population and migrant salary which goes through this. Okay, if Corona settles down and no Corona situation happens, we will go back to the earlier days.
Okay, understood. And last question is on slide number 11. Can you explain that collection efficiency table? Because if I look at various segments, the collection efficiency has come down from October and November level.
Yeah. So So this is on your EMIs. So the reason, and like Rohit had mentioned, if you look at September, and about 10% of the portfolio was in restructuring. So they were broadly under a 2 to 3 month moratorium. So there is no billing for it. So as October, November, December came up, more and more of these restructured loans come for billing, because the moratorium, like I said, is between 1 to 3 months. So as the restructured book came for billing, and we've shared how the restructured book performance is, so it's lower than the non-restructured book. Hence, the collection efficiency started to dip. This collection efficiency is including the restructured book.
Okay, sure, understood. Thank you so much.
Thanks.
Thank you. The next question is from the line of Renish Harishbhai Bhuva from ICICI Securities. Please go ahead.
Yeah, and congrats on a great set of numbers, sir. So just first question is on the credit cost part. So is it fair to assume that Q3 annualized credit costs should be sustainable in FY23? I mean, considering the customer behavior in the restricted portfolio.
So we've given a credit cost guidance of 2.5%. At this point in time, I think we'll stick to that 2.5% overall for the year.
No, I'm talking about FY23.
Oh, sorry, FY23. We are hoping that it should start normalizing, and our normal range is between 1.25, 1.5. So, and then I think that should be next year. Medium term, I think with the portfolio also moving to products like housing and more prime, it should then finally settle at 1%.
Got it, sir. And so just last question is on the CASA front, especially on the saving rate. So our peak SA rate between 5 to 50 lakh is at around 7%, versus peak TD rate at 6%. And we have already witnessed, the interest rate benefit playing through the increased CASA ratio. So when do we see rationalizing rates, with the TD rates on the SA front?
See, we have done 3 course correction. We have to see our average ticket size of SA, as put in this discussion, is 67,000 rupees. Okay, and up to 1 lakh, we are paying only 3.5%, which means all these customers in a laddered approach contribute to. So our 3.5% bucket is grown up by, in fact, close to 50 to 60%. And second bucket, 6%, is in par with most of the SFBs and most of the big private sector banks. 5 to 50 is a segment where program customers are coming in, as I said, through engagement. Till the time we are able to get the investments, insurance and protection and primary accounts right, it will justify by itself. So it's a market driven and the supply driven. And the main intent of doing all these things is, are we getting the cost of funds down? In month-on-month sense, we are getting down by 3 to 4 bits sustained way for last 14, 15 months. We want to accelerate that. So based on that, we will keep calibrating and recalibrating over a period of time.
Got it. So just last data keeping question. So of our total SAP portfolio, what proportion of portfolio will be, let's say, having 7% interest rate?
See, now let us put one perspective. All 100% of the portfolio will have 3.5% interest rate. So that book is 1,400 crore. Okay, the total book is 9,000 crore. Now, second part is we have to go to the next segment, which is called 1 to 5 lakh, which is 6%. Okay, that contributes to 34% of the book. So 1 lakh is contributed by all immaterial of whoever comes in, whoever keeps 1 lakh or 10 lakh or 1 crore. And now between 35 and next, say 84, that contributes to close to 50% of the book is on absolute 7% bucket, which is 5 to 50 lakh. Because greater than 1 crore is 16% of my book. So 45 to 48% it keeps fluctuating.
Got it. So 45 to 50 will be between 7%, will be fluctuating between 6 and 7% basically.
Correct. So that is why we consciously kept it for savers there.
Got it. Yeah, that's it from my side, sir. Thank you.
Thank you. The next question from the line of Sharaj Singh from Laburnum Capital. Please go ahead.
Hi, sir. So my question is on the provisioning. You mentioned going forward the provisioning should improve, but currently it's very low, especially on the VS and the MFI side. So where do you look at the provisioning normalizing? Can you give your thoughts on the LGD and the PD assumptions here? Hello?
Yeah. So the LGDs, we said on vehicle finance, eventually if we recover and write off, it's about 30%. On small business loans, it's much lower. It's about 15% odd. Microfinance, historically, you don't recover anything. But this time, I think we're seeing collections even from the delinquent accounts. So I think that's broadly how the recoveries have been. In terms of normalized provision coverage, if that's what you're asking, I think our aim is to, one, go back to where we were earlier. So hopefully we will cross the 60%. And I think from there, then we'll come back. Yeah. Sorry.
So
and also one more data point. So from a provision, I think, and Sridharan's opening remark, about 300 crores is what we have, which is provided from the restructured pool, the floating provision, and the additional provision which we also have done. So that's the other data point.
Right, sir. But then, as you said, the MFI book, we don't see much recovery. So the coverage here specifically is very, let's say, 40% something, right? So where do you see this normalized? I mean, and our credit cost guidance also continue to be the same. So do you expect the book to pull back or gradually to just recover the provisions to catch up?
Yeah. So see, MFI is directly, as I said, in opening remarks also. So you look at the formal economy is doing very well. Now, whenever there is a recession, it's the formal economy which starts picking up first, and then the informal economy starts kicking in. So in the past also this has happened, particularly during the demon stage, where the informal economy got hit. But after that the business came back, and we could see earlier pre-demon collection efficiency rates. We are experiencing the same thing now. In fact, in the second wave also we saw the same thing. Post the second wave, we saw collection efficiencies improving. So to answer your question, yes. We feel that the business will be back. We will be back to the normal collection efficiencies, delivering normal ROE. Particularly in the MFI business. That was your question.
Right. And the vehicle finance, we also expect the book to pull back?
See, vehicle finance, as I explained, for the first time, vehicle finance, the peak sales for trucks was in FY19. So we have still not reached the peak sale of FY19. But the peak freight rates were in FY21, and we have already reached there. the free cash flow margins of fleet operators has increased. So what has happened is, automatically when replacement demand starts, there definitely is a lot of activity in the used vehicle segment also. So obviously, as business picks up, collection pick up. So the second point is, earlier, load availability itself was a question. Now here, load availability is much better, so truck utilization has gone up significantly in the formal sector. I do expect that in the next quarter, this will percolate down to the used vehicle segment also. There is enough activity in the used vehicle segment now, so that business will also come back.
So how much of a vehicle finance would be HCV?
HCV would be
Heavy.
32% as of now, I guess.
Okay. Thank you. And sir, I'll do so. 32 is good, sir. And in the MFI space, do you see some, given the competition has gone down, a couple of competitors have come under stress, so can we expect some accelerated growth here? And the economy pick up?
See, the MFI business is different business. You can definitely grow that business, but there, the focus should be on discipline, which is maintaining your center meetings. See, there was a survey done by Enfin recently, and Enfin said that earlier in the post-COVID, because of COVID, the center meeting attendance has dropped to 67%. But 67% they are saying is good because the remaining 33% did not happen because of two reasons. One was illness and one was business disruption. So the survey itself says that, the center attendance meeting rates are going to go up. So that itself will improve the MFI business volumes. So volume is not an issue in MFI. It's just that we need to ensure that, we need to continuously assess whether the parameters are good, whether the collection efficiencies are good. As formal economy keeps kicking in, the benefits will percolate down to the informal economy, and the business will be BAU. Does it answer?
So are we looking to grow this book then at a increased pace, or we'll be conservative and stick to the slower growth seen in the recent past? Hello?
So yes, we will grow the book, but we will always, we have already indicated earlier also that it will be, 7% of the 15% of the total book. Right. We will keep it at 15% of the total book, despite the fact that there is enough potential for us to grow more than that. And that's a conscious call.
Okay. And sir, can you give us some timelines on the merger? I mean, any update on that?
Yeah, so we are hoping that post this results, we can complete the QIP process. So we had to take a bit of a break because of New Year and Christmas and results. So we are hoping that if with all your support, we should be able to do this in February. And if we close this in February, then we are looking at completing the reverse merger by December of 2022.
December of 2022, sir?
Yes.
Okay. And so one last question I missed. I missed one question, if I can just answer. In the vehicle finance space, there is increased competition as from what we could understand. So what are the sectors that we focus on? What are the strategy to here in the vehicle finance space?
So you asked me the composition of HCVs. The exact data point in HCVs is just 25% of the advance.
Okay.
So that was one question you had asked me. Secondly, you're asking me what is the roadmap ahead? Yes.
Right.
Yeah. So the used commercial vehicle space itself is a humongous space. As you know, there are very few players here because it's a very difficult business to be in. So our focus is obviously to grow the used commercial vehicle. In used commercial vehicle, we have focused primarily on used LCVs and used small commercial vehicle. And both the portfolios are small commercial vehicle is doing exceedingly well. So we intend to increase both the LCV and the small commercial vehicle.
not so much on the HCV, but more on the LCV and the SCV book. We also intend to focus on the new LCV book. The new LCV book as of now is only 19%, and the new LCV book is one place that we will focus on. Then we have dabbled in used car. Used car has been a phenomenal success for us. So the asset is low, and there are hardly any delinquencies there. So that is another focus area for us.
Yes, sir. So my question actually was, I'll break it into two parts. In the new CV space, there were incumbents which were which were very strong, and we were trying to break in there. So update on that. And in the used space, we have heard from a lot of players that there's increased competition, new players coming in. So there, I mean, how are we looking at the competition going ahead? Is it that.
If you're talking about competition will be there in every product because many people are entering the financial services industry. What augurs well for us is we already have a distribution, we already have a customer base, and we've been in the used space for a long time. That gives us ample opportunity to go into the new space also, because a lot of our existing customers, as they mature, they go in for new vehicles, and that itself gives us a huge replacement demand. So I think we are well poised to take that growth in new LCVs, used cars, and the used CV segment. We have in the new small commercial vehicle, we already have a 7% market share. So that's one space where we are quite dominant.
So new small commercial vehicle, is it some specific OEMs or the overall market we have a 7% share?
Yeah, basically in Tata.
Okay, sir. Okay, thank you, sir. That'll be all. Thank you so much.
Thank you. The next question is from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. I have three questions. One, two are data keeping questions. So first is, out of your restructuring book of 1764 crore, if you can give, I think you mentioned about 900 crores is from vehicle finance, but can you also specify about SBL and MFI?
Yeah. So microfinance is about 340. Small business loans is 440. Sure. The remaining is the MSE finance.
Correct. And this is the gross number, right? So 9% of NPA which is there.
These are the gross numbers. Breakup of 1764 is what I've given.
Correct. So 1764 also includes 9% NPA, which has already...
Correct. 162 is NPA.
Correct. And secondly, on provisioning, the same thing, that you have around 400 crores of specific provisions, and then you have restructuring provisions of around 300 crores. Is there any other provisioning which is outside of restructuring provisioning and specific provisions?
Yeah. So, 1 minute, I'll just give it to Sridhar.
Sridhar here. Over and above the normal provision, we have 202 crores on restructuring provision, and we have a floating provision of 19 and the balance of around 94 crores or something in the over and above the IRAC provisioning, which I have included in my, included in my introductory part.
Right. So this 94 crore over and above IRAC is already there in the PCR, right? Because that is how it should be.
Yes, sir.
Sure. So 400 crores of specific provisions, and then 200 crores on restructuring, and 20 crores which is, let's say, over and above, which is not there in both of them. Is that the math?
400 plus 202, which is a restructuring provision.
Not in PCR.
PCR, we don't include the restructuring standard provision. Because that is not, as per the RBI guideline, we cannot include.
Yeah, so is there any other provisioning which is outside PCR and restructuring? That is what I was asking.
No other provision.
Sure. And the third question is, sir, on your restructuring pool, right? So I heard you that you are saying that the credit cost remains at 2.5%, and I think 9 months is basically 2.5% around. And while this pool, clearly these customers had slightly weaker profile and they were already given 2-3 months of moratorium. And this pool is clearly, delaying payment by, let's say, 1 to 2 months, 37% of them. So how confident are you regarding the credit cost from slippages and credit cost from this pool, even from near-term perspective? And in that context, do you think your policy of 90 days moratorium max was slightly stringent or, slightly more extra conservative?
See, I can only tell you that, the trend that we see today in both X buckets as well as 1 to 90 DPD is good across businesses. I mean, we are seeing a reduction in 1 to 90 DPD buckets. So that gives us a comfort that, despite the fact that some of the RSL tools, particularly in vehicle finance, is in some buckets, that collection is happening and the credit cost will be lower. That is the intent. That is what gives us confidence. Secondly, in the vehicle finance, as I said, as the economy improves and benefits keep trickling into the used segment, we'll be able to get better realization in sale of used trucks. So that is the second point which gives us confidence that credit cost will improve. So does it answer your question? Hello?
Yeah, sir. So I think it does. Yeah, thank you.
Thank you. The next question is from the line of Nidhesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. So on the asset quality, if you look at restructured book and X bucket collection efficiency, still the numbers are a bit elevated. GNPA's collection efficiency, all the numbers are a bit elevated. So what gives us confidence that from this quarter we will be able to redeploy our collection team to sales and we will be able to show growth, or we will do that from next year onwards?
Okay. As I said in my opening remarks, if you look at the restructured pool, in small business loans, 67% of the pool is non-delinquent. In vehicle finance, about 39% of the pool is non-delinquent and 1 to 90 is 45%. In microfinance, about 45% of the pool is non-delinquent. So this is one reason, immediately how does the pool behave. So despite the fact that the NPA has started collection, a lot of customers are paying. So that is why I'm saying that the pool might behave better. This is one. Secondly, when we look at collection efficiencies in the higher bucket, there also we see that despite the fact that customers are in buckets, particularly in vehicle finance, they're at least paying us 1 EMI, 2 EMI, so it's moving. It's not deteriorating, it's improving. So this is the second reason why it gives us the confidence that collection efficiencies in the restructured pool will be better.
And the redeployment will be calibrated. It is not one day that they will have no collection scheme and they're all in the front line. So it will be calibrated, and we also have a fairly strong collection vertical, which in our assessment can take care of the current overdue in terms of number of customers.
Secondly, whenever there is a issue on the collection side, what we have seen that our incremental growth tends to suffer because we need to redeploy people from sales to collection, despite we are having almost 17,000 people in the organization. So if let's say we would have reported strong growth in this quarter, all the numbers like profitability, GNPA would have looked much better. Even the collection efficiency numbers would have looked much better versus what we have reported. So do you think this is the right strategy that we always prefer to redeploy people from sales to collection, and how you measure the effectiveness of those people in terms of collections?
Yeah. See, I think it's a question of how do we manage and balance between percentages and the actual amounts. There are times when you can ignore the actual amounts, just look at the percentage and keep growing your book and expecting that at some point down the line, the percentages will be able to cover up the asset quality issues and help you overcome that over a period of time. So I think it's and how do we manage it? So it's very difficult to give a one one answer to that question. At what point does a company focus on collection? At what point does a company say that I'm okay with some level of increase in the actual quantum of overdue and NPA, but I'll grow my book so that my percentages appear to be under control. So at what point do a company take this kind of calls? I think it's not something where we can say that generally there's only one clear guideline on which everybody will act. So it's not going to be possible to answer that question. I think we have to take it based on so many factors. Finally, you make a call, and we took that call in the last 2 years post the pandemic, except of course during that brief lull between the wave 1 and wave 2. I mean, we didn't know wave 2 existed, right? We thought that we were all finished with corona in India, and so there was that brief period of Jan to March where everything looked good and we just were back to normal. But again the wave 2 hit and it's been quite different after that. So we have taken this view that we will continue to focus on growth, but at the same time we want to also keep the overdue amounts under control and the actual amount of write-off etc. under control. So it's very difficult to give a one-word answer to that. It's a factor of so many things that you take into account. So now and also it's a question of the management's views and the confidence in the market to kind of behaving and coming back. So I think it's a question of that. And from our side, what Rohit has been mentioning to you is that from our side we believe that the corona effect is actually kind of behind us on our portfolio. Yes, there is still this remaining restructured loans which are already in overdue. Half of them are in X bucket and about 20% of them are in 1 to 30, which is okay. The balance 30% are really in the 30 to 60 or 60 to 90 or 90 plus. So that is still there and that will be continuing to be a focus for the collections and the legal team to pursue. But we believe that the corona effect more or less on our portfolio is behind us, and so we should be able to get back to our normal levels of growth, starting from next year.
Sure, sir. And lastly, sir, from a productivity perspective, how should we see the productivity of our sales force, collection team? So I'm trying to understand from the same infrastructure that we have, what sort of disbursement run rate or loan book that we can build with the same infrastructure on the asset side that we have?
Yes, you are right. Productivity is a focus area for us, and we have benchmarks for productivity, and every month we monitor those benchmarks for productivity, and this will be one of our focus areas of improving that productivity as we go along. So you are right. That is a focus area for us. Yes.
Sure. So I was just trying to understand whether we are running at 50% capacity, 50% capacity, or if we want to grow, let's say, disbursement by 50%, we have to add 50% more people. That's what I was trying to understand, if that's possible to answer.
We are at about 85% capacity, and as we keep deploying people, as the business grows, that the additional need will be fulfilled. Yeah.
Understood. Thank you, sir. That's it from my side.
Thanks.
Thank you. The next question is from the line of Abhishek Murarka from HSBC. Please go ahead.
Yeah, hello. Thanks for taking my question. So my first question is just on disbursements. If you can give a bit of a trend that you have been seeing in January, and just approximately how much of the sales which have been put into collection have been redeployed or sent back to sales. So just to try to get an understanding of how this trajectory is behaving now.
But as you're aware, no, January we have a 1 week holiday in India because of Pongal. So considering that, the logins are better, but it will not be as great as December was. So this is one. Secondly,
just for context, December we had done about 1,200 crores.
Okay.
So October and November were actually very muted. We started to calibrate in December. December we did 1,200 crores in a month. So our hope is that on an average we should be better than December.
So what you're saying is, roughly if you take 3 weeks, then approximately you should do 900 crores because 1 week is lost due to holidays and stuff. You should be hitting a 900 kind of disbursement level.
Nearly about. Somewhere between 825 and 900.
Understood. And how much of this bounce back have you seen in SBL?
Yes. Now you are indirectly asking me segmental of SBL. I don't know which one will be.
No, this is just to get an understanding because it's your largest segment. So I'm just trying to see how growth is panning out there.
30%.
30% is SBL.
Okay. Great. And secondly, on OPEX, so Srijan was suggesting that the IT cost, which is part of that 411, that has grown about 70-75% YOY. Just wanted to get a sense of how much that is. So that is like 10% of 411, or what order of magnitude is that?
I think the variance between last year, same time, and this quarter is about 15 to 20 crores.
Okay.
And this is not digital, so let's not mix it. This is
of course.
Technology cost. Yeah.
Right. And I think Vasu also mentioned that you're looking to expand the VIM team and you're seeing a lot of passion in there and sales teams also. So just broadly on the 17,500.
Your voice is breaking up at times. We cannot hear you very clearly.
Okay, I'll just repeat. So I just wanted to get a sense of your hiring plans in the next, say, year.
Yeah, we are actually in the business planning period right now. So I think we'll all speak out of turn if we try to give you some idea. But next quarter, I think we should give you some sense.
Okay. All right. Thank you so much. And all the best.
Thanks, Abhishek.
Thank you. The next question is from the line of Vijay Karpe from Bryanston Investments. Please go ahead.
Thank you for giving me this opportunity. Happy New Year.
Sorry to interrupt you, Vijay. Can you please speak a bit louder? We cannot hear you very well.
Thank you for the opportunity. Happy New Year to the entire team of Equitas Efficiencies. My first question is, what was the X bucket in September 21? Because according to the Q3 presentation, it is 80%, and according to Q2 presentation, it is 85%. So, what is it exactly in September? 80 or 85%?
No, September is 80 only. That's what we had given. That 80 is September X bucket.
Okay. And according to the Q2 presentation, it is 85%.
Correct. 1 quarter has passed. Sorry. Just give me 1 second. Let me. 82. So it's 82 versus 80.
Yes, I understand that, but it was mentioned that in September it was 85 in the Q2 presentation.
Oh, sorry. In the Q2 presentation, it was mentioned as 85 is what you're saying.
Yes.
Okay, let me just check that. Sorry.
Do you want me to give the page number?
No, it's fine. Let's check this and come back.
Okay.
Yeah.
My next question is, so how much of the write-off was in the NF segment, and do we see any major write-offs in the future?
In MFI, it is 55 crores is write-off.
55 crores. Okay, and do we see any major write-offs in the future?
Future, see, we have put in a policy actually. So as per the policy, wherever 100% provision is there and we have certain other parameters, as per that we go by that.
Okay. And where do you see the collection efficiency moving in the Q4 quarter for both the normal portfolio as well as the restructured portfolio? The NF disbursements also saw traction in the Q3 quarter. What was the mix of the new and existing borrowers, and what do you feel is the asset quality of this new disbursements?
Okay, I don't have a breakup of the used and existing for the new and existing customers in MF. You are asking me about where the collection efficiencies will be. So as I said, our current collection efficiency in MF is 97%. Our normal collection efficiency used to be 99%. But when we see the collection efficiencies across geography, which means taking each state, we find that the collection efficiencies across states, overall collection efficiencies has improved, which means our ex-bucket collection efficiency in MFI will definitely be higher than 97%. It might not touch 99% immediately, but it will definitely be higher than 97%. That is our expectation.
Okay, got it. Our disbursements were also impacted during the quarter. How much was this attributed to deploying the sales team to the collections, and also how much is attributed to the floods that happened during the quarter?
No, it is not attributed to redeployment of people, because if we find that the demand is strong and we just want to focus on sales, then we would have deployed it. But actually what happened was in November, we had a storm in TN and we had a lot of rain. So business activity had come to a standstill for quite some time. That did impact the disbursement.
Okay. And lastly, I think we have made some changes to our savings account segmentation. Earlier, we used to keep them 1 lakh and below, and the rest of the rates were for 1 lakh and above. So I think we have made some changes over there. Less than 1 lakh, between 1 to 5, and between 5 to 50 lakhs. So how much will this help us reduce our funding costs over here on the savings account side? And that is one. And the second question is, I think we have seen a good fall in the MF AUM. Why is it so?
Two things. First is, we have now categorized based on mass affluent and HNI. So that is why 0 to 1, 1 to 5, and greater than 5 to 50. It is categorically decided between product and program. Earlier, we kept only a value as a program, that is anything above 1 lakh is 7%. Right? So we have consciously done that so that it helps us to reduce overall in a yearly sense by 24 to 28 bits, depending upon which cycle you are catching up. That is on that. Second, it is not fall in AUM. It needs to be corrected. It should be 139 moving up to 170. So we will correct that and we will reproduce it for you.
Great. Thank you so much.
Thank you. The next question is from the line of Abhijit Sakhare from Kotak Securities. Please go ahead.
Yeah, all questions are answered, but I just wanted to check the two pie charts on slide 24 on savings and TD. That's identical as the previous quarter. So just wanted to confirm that. That's
okay. Yeah. Identical in the sense, we'll just double check that, and then we'll update the PPT if there's a mistake in it.
Great. Thanks a lot.
Thank you. The next question is from the line of Harish from Harish Ravinathan Family Office. Please go ahead.
Thank you. I just have one question on the universal bank license. So where are we on the application, if you can give any update? And secondly, getting the license, how will it change our strategy or focus as a bank? Thank you.
See, as per the SFB guidelines of RBI, up to 5 years we have to be an SFB. After that, it is not an automatic upgrade to universal bank license. After that, we have to apply and it has to be approved by RBI based on the regulatory comfort. That's the guideline of SOBs. So we have completed our 5 years. So we are in discussion with RBI, and as and when they allow us to apply, then we will be applying. So right now we are not in a position to really talk of timelines. But the second question is something that we can clearly talk about, that as and when we get a universal bank license, it actually will not really mean any change as far as the business model is concerned. We are very comfortable with the model that we have got so far. We have created. It's a very strong, stable, and robust model. We can really build a good amount of volume on top of the model that we have created. We are distributed presence in products, distributed presence in customer segments, and a very strong liability traction that we have been able to see to support the asset growth. So we are very comfortable with the model that we have got, including the fact that a significant part of our loans are to the informal economic customers, where the unmet demand continues to remain very large and not an easy area to lend. And we have been able to establish a good amount of capability to lend and collect from that segment. So I think we have built a good amount of moat in many of the business lines we are in. And so whenever we become a universal bank, I don't think that's really going to change our model in any significant way.
Thank you.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for today. I now hand the conference over to Mr. P.N. Vasudevan for his closing comments.
Thank you all for joining us, and it's been an hour and a half, pretty long marathon session. Thank you for staying with us and asking us all these questions. It always helps us to sharpen ourselves and improve ourselves the more and more you ask us. So please continue to ask us as many searching and strong and searching questions that you can. Please go ahead and keep asking us. It will always help us strengthen ourselves. Thank you so much, and wishing you all the very best. Bye.
Thank you. On behalf of Equitas Small Finance Bank Limited, that concludes this conference. Thank you for joining us. Thank you. On behalf of Equitas Small Finance Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.